Hello and welcome back to All Things Money. I'm your host, David Blain. During today's show, we're talking about what a long-term investor should do based on the recent rise in interest rates and all the prognostications of the Federal Reserve, Ben Bernanke, what's going on up there. And we outlined a few things, a couple of points in the first segment. If you missed it, head on over there to the website, www.dlblain.com. We'll have archived copies of the show posted there. We got a lot to get through today, so I'm not going to do much recap. If you missed it, you're just going to have to listen to the archive. We were on, the point I was making was that the rise in interest rates is already priced into the price of bonds and instruments today, so there's no value in you sitting there thinking, well, in the future I think interest rates going to rise, because it's already priced in today what the aggregate market feels like price is going to rise to. Now, in the future, they may reprice it. They may think it's going to rise more. And that, not to say they can't, but the aggregate market today is pricing in what the future expectations of interest rates are. And I wanted to mention that, you know, a lot of times we talk about these things, but the reality is we don't know what's going to happen next. We don't know. There's too many variables. And if we rewind the clock back to November of 2010, when Bernanke was engaging in QE 2 or 3, I forget which one, there was a letter written by 23 prominent economists to the Federal Reserve saying that, and I'll quote from this letter, this was November of 2010, "The planned asset purchases risk currency debasement and inflation, and worry that another round of asset purchases, interest rates still near zero, will distort financial markets, etc." Now, I happen to agree with what these people wrote. And by the way, there's people from Stanford University, Columbia University, Stanford, Harvard, Manhattan Institute, Stanford, you know, all these luminaries in finance and academia and everything warning about debasement of the currency and runaway inflation. I happen to agree long term, you know, it still causes me concern, but when you're investing, what you got to realize is that you don't have any information that other people don't, and that these great economists have no earthly idea what's going to happen next any more than, you know, your next door neighbor. And that's the point, is that maybe long term, but we see that inflation is basically exactly where it was when these supposedly, you know, really smart people predicted runaway inflation. We see that the dollar is actually higher than where it was when Bernanke engaged in these in this next round of quantitative easing. So my point is that, you know, I have concerns about the future as well, but when you're investing, that is already priced in the market, and to try to take advantage of it, it's almost impossible. And to take the forecasts of supposed experts and use it for an investment strategy, it's just a bad idea. That's the point that I want to make, not whether 10 years from now the currency is debased or inflation is going up. The reality is that people looking at that in 2010 said, oh, look at all these smart people, and, you know, I need to sell out of these assets. Well, you missed a huge run-up from November of 2010 to today. And that's my point, is that there are no experts that can predict the market, and anyone that thinks they can is severely mistaken. So it just take these predictions that people make out there with a healthy dose of skepticism, that, you know, the likely path of bond yields, interest rates, currencies, all that kind of stuff, no one can predict that. All right, the other thing, that the rise in bond yields actually equates to a fall in prices. And just like stocks, it's beyond me why a long-term investor is not excited when the price of things fall, especially if you're a buyer. Now, even retirees, the rise in interest rates allows more income to be thrown off. So if you own, 1,000 shares of something that 3 months ago had a 2% dividend yield, and you still own 1,000 shares of it, but now it has a 4% dividend yield. Over time, that income is gonna help catch things up. But anyway, in most things in life, when the price drops, people get excited. It's called a sale. For some reason, in the financial markets, a drop in price causes people to panic. The last thing, well, maybe not the last thing, but the second to last thing is a lot of this volatility in the markets unnerves people that pay the most attention to it. I tell this little story to my clients all the time. They come in and, I watch the markets every day. I look at clients' portfolios all the time, and we're constantly looking at them and assessing, where clients are in terms of their goals and what's happening. Does it affect their ability to reach goals? Simply so that we can educate people and set them at ease. But I tell people, I have no earthly idea what my own portfolio is doing. I don't look at it. I haven't looked at it in years. I don't think I've actually looked at a statement of my own account for years. Now I know what's going on in the markets because this is my job, but to look at my actual state, I don't know. I'm a long-term investor. I put money in every month and just let it grow and compound. And the people that watch this stuff all the time are the people that make the absolute worst long-term investment decisions. Okay, well, we're coming up on our next break. When we come back, we'll finish up on this topic about what the implications of the recent market volatility for a long-term investor might be.